And the markets could not care any less that the ECB issued its first rate cut in 5 years. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And the markets really told everyone exactly where their focus was with this ECB monetary policy announcement that we just got over the past 24 hours here. They don't care what the ECB has to say. The cut, of course, was widely expected, but as typically happens around central bank policy announcements, it's not really the move that matters. It's what the guidance is going to be, because markets are forward looking, and the ECB offered plenty of guidance, but no one cared because the focus very plainly is on the Fed and what that might do going forward as informed by US economic data. And that, of course, takes us to precisely what we are going to talk about here today, the incoming jobs report for May. This is easily the biggest piece of event risk this week, but it may not be the most impactful considering how much the markets had to say about the ISM report earlier this week. We, of course, talked about that in detail yesterday, and we'll touch on it again today. But what we're going to be looking at here first and foremost is going to be all of the various tea leaves that are there to be read ahead of this jobs report. We'll talk about why it matters. We'll talk about what it is about it that might be market moving versus not. And then see if we can paint for ourselves a bit of a narrative and a scenario matrix for outcomes. Obviously, no one knows exactly what the future holds, but the object of what we're trying to do here as watchers of macro is to get a sense of what the probabilities are, to get a sense of what the likely scenarios could be and what the price action in those scenarios might tell us going forward. So watching all of this data is in many ways a lens tuning exercise. What we're trying to figure out is what matters for the markets and why. And from that, to inform a trading strategy. So we begin with why this matters. And this right here is, of course, in the blue, the S&P 500 as a kind of benchmark for overall Wall Street sentiment and overall risk appetite across financial markets, a kind of catch-all benchmark for that. And in the gray bars is the outlook for how many rate cuts we're expecting to see this year from the Fed, backed out of Fed funds futures. In the yellow is how many of them are on the menu for next year. And in the orange line, there is the sum of the two. So this is the aggregate right here. So notice the interplay between what's been occurring here. When we came into the year, the focus clearly was on the Fed starting a conversation about rate cuts. It began late last year with the genesis of this rally. We can see the cumulative change in rates went from a bias to hikes to now a bias to cuts. That rollover got stocks marching higher, of course, on the promise that with all the various risks out there in the world, be it a war over here, be it a war over there, be it the prospect of what higher rates might do ultimately to the economy or to record high debt levels internationally. Through all of that, it is much easier to deploy risk if the world's most significant, most powerful central bank, the driver of global borrowing costs, not just US borrowing costs, is telling you that it's going to give you cheaper money in the future. Because even if one of those risks comes out to bite you and you lose money, you can borrow back cheaper later and go again. So, not surprisingly, when this rolls over, stocks move higher. We enter this year with obviously a considerable rate cut outlook over the 2-year period ahead. Markets are looking for rates to come down by a good 2 percentage points this year and next. And we can see that as we've gotten warmer U.S. economic data, mainly through the first half of this year going into the second, this upshift has erased some cuts, but stocks have managed to continue to go higher. We clearly are getting into some spicy territory here. So we can see that most recently, the outlook for this year has basically steadied. From about the middle of April, the markets have stood on their square, calling for about a cut and a half this year. So call it 125 basis point reduction baked in. It is currently fully priced in for November with some optionality for September, and about a 50-50 shot, give or take, at a second cut. And this is where the markets have been essentially for 6 weeks. We can see here that once we started to climb into a more hawkish setting than where this thing started to turn, so essentially, if you look at this here, once we started to climb through that, stocks swooned. You can see that with this upswing here. This was apparently the pain point for markets. But then once this anchored, largely around the Fed saying, look, we see that disinflation with this hotter economic data has paused. To that point, PCE inflation has been stuck at 2.8% now for 3 consecutive months, as we just saw with Friday's data last week. Now the bogey has shifted. The Fed has said, look, obviously this inflation is stickier. We don't feel confident in cutting, but we think that rates currently are going to be high enough to ultimately get done what we want to do. So we're not going to hike either. Hence this anchoring and a kind of higher for longer perspective for markets, which has since shifted the focus to the 2025 outlook. We can see here that as this outlook started to get more dovish, here, stocks were able to resume their ascent. As it hit a roadblock here and pulled in, stocks got stuck. As it started to build back out, stocks resumed their advance. So it's very clear here, seemingly, that the driving force behind markets is 2025 Fed rate cut speculation. That's what's moving here. We can see that hawkish adjustment for this year, incidentally, when we see how over the past 2 months and over the course of the past 2 Fed policy announcements, the implied curve for this year has evolved. That would be this adjustment here. You can see it is now meaningfully more hawkish, but that between May and where we are today, we are basically unchanged. The big shift happened between the March Fed policy announcement and the May one. And since then, we're steady. This was more dovish. May was more hawkish. We're going into next week's Fed policy announcement basically unchanged. Policy rate at 5.33, we can see holds through the summer. We get into some optionality for a cut in September, as we just said. By November, the cut's there. But that's about it. The rest of the year looks like we're going to finish near 5%, amounting to a bit more than a 25 basis point cut, so that there's that optionality for perhaps a second one, but it's about a 50-50 shot. So this is what we care about. With that in mind, here's the expectation for the jobs report. We're looking for the economy to add, and this depends on which aggregating number you look at, between 180 and 185,000 jobs. It really doesn't matter one way or another, 5K this or that way. Different aggregates, be it Reuters or Bloomberg or whatever you might be looking at, that compiles different forecasts. The upshot is about the same. Whatever outcome that forecast is pointing to would very clearly fall within the range that has been basically the idle setting for U.S. job creation, between 136,000 and 480, going back to the end of 2022. If you want to zoom in even a little bit closer, between 165 and 303, going back to about a year ago. So for about a year, this has gone not very far at all, averaging, let's call it about 200,000. And that's really the kind of on-trend, nothing to see here outcome that is expected. The unemployment rate, likewise, seen holding steady, 3.9% for a second consecutive month. Why is this an input into our Fed inflation calculus? Well, we can see just briefly from the latest PCE numbers that it is core services that is the last bastion of inflation. The Fed can't really do anything about that bit about housing. It's got to start cutting rates to bring both buyers and sellers back into the market. Sellers don't want to sell because they don't want to refinance whatever their next living situation is at elevated mortgage rates, so they're not selling. They're not selling, so the price isn't coming down. The buyers are priced out both by mortgage rates and by housing not correcting lower in terms of price, certainly not in earnest. And so the housing market is stuck and inflation is stuck in it. Nothing the Fed can really do about that until the cuts can begin. And of course, the bulk of the story is in core services here. That is primarily a story about labor. Most of the U.S. economy is employed in the service sector. It is about 70% of the overall economy and even a bigger share of overall employment. We can see here that we had, during COVID, a giant spike in labor surplus, so vast oversupply relative to demand, because of course the entire economy was on lockdown. Everybody got sent home. As the economy reopened, all of this went the other way, and of course inflation picked up immediately. This inflation has really been about scarcity in the labor market. That scarcity built out to about 6 million jobs at the peak for inflation. It has since been slowly working down, which has helped inflation to come in. But of course, this was not the only part of the inflation story. So we can see, as this has been coming down, goods inflation vanished, energy inflation vanished. So here's food, here are goods. They went from inflationary to now basically a goose egg. Energy went from being an important contributor to being a negative contributor to now next to nothing. Food has gone from a significant story to next to nothing. So this has had a significant decline in excess of what's going on in the labor market, but this has helped. It's gone from 6 million to 2, but we seem to be stuck here. And as we've gotten stuck here, so too inflation has been stuck as well. We can see that while overall inflation has come in dramatically, it's been cut by more than half. Employment cost index measure of wage growth here has gone down by less than 1%. So this is why we're focused on this. If the jobs data is going to tell us that disinflation is going to continue, that means more rate cuts. and the market's like that, as we've just seen. If the data tells us that scope for rate cuts is diminished because this lockup in the labor market continues and inflation is still sticky, well, then the markets are not going to like that. The leading indications that we've seen this week are telling us that indeed the labor market is cooling. This was the jobs opening number for April. It's a little bit lagged, but we can see here lower than expected, 8.06 million job openings versus 8.34 million expected. So that's cooling. And indeed, we can see that a lot of this imbalance has been less about jobs being lost and more about openings coming down. So this peak right here and this one here is the same exact thing. Openings coming in has meant the implied gap here has narrowed. But because the unemployment rate hasn't really gone very far at all, you can see it stayed quite low, this has not been because of big economy-wide layoffs. It has been because the number of job openings has diminished. We saw a private sector estimate for these numbers earlier this week. This is from ADP, the payrolls company. And we can see here a little bit weaker than expected. 175,000 jobs for the private sector number were expected. The actual was 152,000. So again, some tepid signs of cooling in the jobs market. The ISM survey that we saw this week, first for manufacturing, then for services, gave us a mixed picture. We can see that hiring in manufacturing surged and actually jumped back above that 50 boom-bust level that separates contraction and expansion. Now at 51.1, suggesting the manufacturing sector is actually seeing some positive job creation for the first time really since about the middle of last year. But services still disappointing. The pace of contraction here has eased a bit between April and May, but services is a much bigger part of the economy. So job losses in services are likely to, at least to a significant extent, offset now positive job creation in manufacturing. That sector only about 20% of the economy. In fact, S&P Global, which published its PMI survey revisions this week, made this point exactly, saying in their survey, we saw a pickup of job creation in manufacturing, but any kind of net positive there for the economy was offset to a large extent by job losses in services. And so the on net employment was little changed, which sort of speaks to these staid expectations on net for what's going on with NFP, the payrolls number. Having said that, we saw earlier this week that U.S. economic data seems to have turned a corner. This is the Citi Economic Surprise Index. It shows us that U.S. economic data, in terms of its performance, not in absolute terms, but relative to forecasts, has cautiously improved just over the past, let's call it about 2 weeks here. What's changed? Well, we can see here, this is a 20-day moving average. And the macro data cycle tends to be about a month long. Most data releases are published monthly. There's a smattering of them that are published quarterly, like, for example, GDP numbers or indeed that employment cost index survey. There's a smattering of them that are published weekly, like crude oil inventories or jobless claims. But most economic data is on a monthly cycle. This means that typically analysts are revising their models for expectations about once a month. So it's meaningful to look at the monthly average for this, because when the underlying numbers cross through that monthly average, it means that whatever the models were tuned to seeing, with about a month in between each major overhaul, seems to be either on the optimistic or the pessimistic side of realized outcomes as they're coming in. So you can see here that when you get through the average here, you get follow through. When you get through it here, you get follow through this way, this way, this way, here, here, here. It's a pattern that that's continued here for clearly some time. And I've only put a look back here to the beginning of last year, but if you pulled it back, you'd see it over and over and over again. So we have here another shift through this average, which may set up extension this way. We saw that in spades with the ISM data this week that the markets cheered so hard. It was much, much stronger than expected. Why did the markets cheer it, even though you might have expected a number like that to push back on Fed rate cutoff? As we just saw with that S&P chart earlier. Well, the internals of the report showed a strong pickup in demand, strong pickup in economic activity, new orders and business activity numbers off the charts, especially business activity. But the measure of the price structure and employment went down. So it was growth, but without inflation fears. This is the interplay that we are now looking at here for this set of numbers for NFP. Because out of this report, out of this jobs report, we are going to get not just that headline number for the payrolls increase, not just the unemployment numbers, but also, as you can see on the screen there, average hourly earnings. That is a measure of wage inflation. You can see it's expected to hold unchanged here at 3.9%. That would match the 3-month low that was recorded in April. If that number ends up being hotter than expected, that would be the ISM report in reverse. So although the headline might well surprise higher in line with what we are seeing here, if the wage numbers also do, well, then we have something that impacts negatively the market's rate cut expectations and stocks come down. If we get the chipper headline and this doesn't pick up or even tick lower, well, then the markets have the same Goldilocks result that ISM was so potent in catalyzing. And then, of course, if the headline misses but inflation picks up, that would be the worst of all possible worlds. Slower growth, hotter inflation. So weaker economy and less support from the Fed to fix it. And if you get slower growth and slower inflation, it's the slower growth that's probably playing second fiddle. It's the lower inflation that the markets would like. And so we were probably well supported. And that's the sort of scenario matrix that we're looking at. But it's the interplay between this number and this number and the permutations for their relationship that we are eyeing here to see what Wall Street will do next most closely. And that is macro money for today. As ever, we are here Monday through Thursday every week, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what it means with a view to what might follow. I'm back on with Chris for Futures Power Hour on Fridays, on with Victor for the Price of Truth on Wednesdays, back on with Victor for First Call on Sundays, writing for the news and insights portion of tastylive.com. As a matter of fact, a summary of exactly this analysis is there now. And opining on the platform formerly known as Twitter at Ilias Pivac. Thanks very much for joining. Macro Money's back next week.